I'll go through it. There's Sandra. Welcome, welcome, welcome. Sandra, I was just telling Angelica, if you want to take notes, this tonight would probably be a note-taking class. Otherwise, you can kind of just watch the replay on it too. Either one will work. Either one will work. All right, so I think straight. Awesome. All right, so tonight I want to talk about one of my favorite tools, and it's the Fibonacci tool. This is a tool that once I learned it, I really used it. I started using it every time I started looking at the markets to trade. As you guys have been kind of going through the, let me record this stuff. Gotta record. I always forget to record. All right. As you guys have been going through the video trainings and the lessons and stuff like that, you're learning all these terminologies and tools and indicators and scanners and all this kind of stuff, which is all awesome and great. And you know, you got to have this toolbox full of things when you get into trading. But you'll find something that just kind of sticks with you. And then that just kind of works, something that's kind of easy for you. And as you guys go through this training journey, that's what I'm kind of here to help you with, is once you find that thing, how to kind of master that thing and how to kind of use it to your advantage for whatever you're trying to accomplish in your trading journey. And when I found Fibonacci, it was one of those things that it like clicked to me. It came really simple. And so I use it all the time now. A lot of the harmonic patterns that you see on the scanner are based off Fibonacci numbers and Fibonacci ratios. So there's a bunch of different aspects of Fibonacci we could go into, but I'm really going to talk about the basics of Fibonacci, how most people use Fibonacci, and then in some like later trainings we can definitely do some deep dive Fibonacci stuff. So I kind of got a PowerPoint. I was going to go straight to charts, but I have a PowerPoint because I'm going to take some time with this as you guys kind of go through it, because it's definitely not something I want to rush teaching. And I really can't even teach all of it that I want to in tonight's session, just because I really like this particular subject. So if you guys find that it really helps you and it really comes easier to you, definitely we can expound on it as we kind of learn and teach and all that kind of good stuff. So I'm going to show my desktop, and hopefully in the recording, all the images is not going to be in front of everybody. And let me also make sure I keep an eye on the chat. So if you guys have some questions, just shoot it over in the chat and the Zoom chat, and we will discuss it. So what is Fibonacci? Generally, you'll see Fibonacci ratios and things that have these Fibonacci dimensions in different things in nature, in structures. The human face is known to have Fibonacci ratios. The Star of David, plants, all that kind of stuff has these Fibonacci ratios. And I'm going to show you on the chart how this thing is like awesome, because it's just awesome. So kind of doing like a little back history. And this is kind of why I wanted to do the slideshows tonight, because buddy of mine called me and we were talking about Bitcoin, and I told him to reference this 1929 stock market chart. As you guys, I'm sure, know that Bitcoin is just going through the roof right now, getting close to 10,000. I'm not sure if we touched it or not today. I wasn't paying attention this afternoon to it. But we've gone in a straight parabolic movement. And if you look at the stock chart between the Dow between 1925 and 1929, we had a similar type of move where the market went from 115 area up to close to 400. Okay. And so when you're looking to buy anything, Forex, that's what we're, mainly trading, but this applies to stocks and all that kind of stuff too. you don't want to buy at the tops. You really want to wait for market corrections or some type of indicator to get into the market. You just don't want to arbitrarily buy. You want to, buy after the market breaks out of our support level, breaks out of a resistance level. You might see the MACD or the RSI overbought or oversold, like we kind of talked about last week. So you want to use these different indicators to kind of help you pick better prices to get into the market and get out of the market. And when we look at 1925 to 1929, we see how the market goes pretty much straight up in the air. There's no real big market correction or pullback. Something that we're kind of expecting to happen right now and going into 2018, because the market's been going straight up again. And then when we look at this next chart from 1925 all the way to 1931 now, we see the market fell off really, really strong, very, very quickly as well. And the same thing happened in 2007. We all remember that as well. But notice the yellow highlighted boxes. This is where there was some support level that was established in the market right around the 217 area. Okay. So the market goes from 115 all the way up to close to 400, and it drops real sharply. But like when it got to like 217, you see this massive bounce in the market where it bounces from 217 back up close to 300. And then it falls again to that 217 area again, and it holds for a couple more months and has a nice little bounce off of there back up to the 250 area. And these bounces in the market happened before all the technology moved in and all this, auto traders and stuff like that. And so we start to see the psychology of the market, the psychology of the buyers and sellers. And we try to, we use tools now to say what happened at that 217 area. Why was that level where the market just stopped? It was falling so hard, and it just stopped at that one level. And then it bounces and stops at that level again and has a hesitation. And so what we use is something called Fibonacci to really view the market psychology, what's behind these traders. And Fibonacci wasn't established, it wasn't used, I'll put it that way, it wasn't used back in the 1925, 1931, because we didn't have computers that were, doing auto trading with, all these tools and everything like that. And so when we look at chart analysis, we actually can see what happened back then. And using the Fibonacci, we see that if we would have had that on our chart, we would kind of have known where the market was going to stop using technical analysis. Back then, they didn't have technical analysis. They didn't know when the market was going to stop. But for some reason, it stopped right at that level. And that level that it stopped at is a really, really, really key level. And we're going to get into that. All right. So the indicators that we kind of went over last week were lagging indicators. Basically, we had to wait for that crossover to happen. So when we looked at the MACD and stochastics, we had to wait for that, teal line to cross over the red line or the yellow line to cross over the blue line. That was our indication that we could look for setups to get into that particular market. If we saw the RSI go below 30, then we knew that was our buy signal. If we saw it go above 70, we knew that was our sell signal. But if we really start looking at the charts really close, and we're going to kind of do this on Thursday, I'm going to compare them both at the same time for you guys so you can see the difference. Those indicators kind of give us late reactions to get into the market. I like to get into the market before everybody else gets into the market. I like to find those good entry prices to get into the market. And that's why I really fell in love with using Fibonacci. And the harmonic scanner does the same thing, because it gives you the entries, the potential entries before the market even gets there. The RSIs and the stochastics and the MACDs give you the entries after the price has already got to a certain point, and then you're looking to get in. Two different styles of trading. That's why, when you're learning how to trade or you're learning from somebody, you kind of want to know why they're trading a certain way, because everything is a little bit different depending on who your mentor is or who you're learning to trade from. You just kind of got to know why they're looking at certain things the way they are. And one of the things I focus heavily on personally is Fibonacci. Fibonacci's act as key support and resistance layers. So we kind of saw that in the chart. And they give you price targets as well. So these are some advantages of Fibonacci. So let's kind of break this down a little bit. All right. Now, Fibonacci is a series of numbers. Okay. So if I got to go slow on here, definitely let me know. It's a series of numbers. And the way you come up with the next number in the Fibonacci sequence is to add the previous two numbers together. So looking at the slide, if we take 0 plus 1, it'll equal to 1. And then if we take our 1 plus the previous 1, it equals to 2. We take our 2, add it to the previous 1 is equal to 3. Take our 3, add it to the previous 2 is equal to 5. So on and so forth. And that's how you come up with this sequence of numbers, 2, 3, 5, 8, 13, 21, 34, 55, 89, so on and so forth, okay? That's just what it is, okay? Now, let's kind of do a little math, all right? That's the easy part. That's how you come up with the numbers. So you don't have to, know how to come up with the numbers, but that's just how it's put together. Now, here's the interesting thing. Anybody that's done some math scholaring or anything like that has probably seen something like this, but this is very, very interesting. If you take the sets of Fibonacci numbers and you divide them, you'll come up with these specific ratios, okay? So 34 and 55, they are right next to each other in the Fibonacci sequence. And so if you take 34 divided by 55, you get 0.618. Okay, in that red box. Now, if you jump over to the green box, it's reversed. And if you take 55 divided by 34, you get 1.618. Okay, and it's the same way for, I just broke down different numbers that are right next to each other in the Fibonacci sequence. So 55 and 89 are right next to each other. 89 and 144 are right next to each other. So whatever you divide that's right next to each other in the Fibonacci sequence, you're going to get 0.618. Now, outside of the very, very first numbers where you have, 1 divided by 1 or 2 divided by 1, obviously you're not going to get the 0.618. But as you get to, off of those 50% and all that stuff into the Fibonacci ratios, this is what you get. Now, if you take Fibonacci numbers that have a number between them, like the purple box there, we have 34 divided by 89. The Fibonacci number in between that is 55. So we're going to drop out the 55 and do, the two outside numbers. You get 0.382. And then if you flip that around in the orange box, you see we get 2.618. And these are just how you make up these Fibonacci numbers. We're taking the actual numbers in the sequence and dividing them, and you come up with these ratios in the market. Now, if I jump back up here to the chart, and I'm going to come back to this in case you guys want to screenshot this or something. If I come back up here to this first or second chart I showed you, this blue line with the yellow highlighted boxes, the market fell at a 618% ratio, okay? So it went all the way from 115 to close to 400, and it fell down 0.618, okay, which just so happens to be what's known as the golden ratio, which is a very, very key number no matter what you're looking at when you start to see market pullbacks or market corrections. So this 0.618, if you would have just put that on your chart and just had a buy order in at 0.618 of this move, then it would have been two decent trades right there. One would have been really good. The second one would have been, a nice, decent bounce off of that. But without even having to, guess where the market would potentially stop at, we can use these ratios that are already defined. Okay. Let me jump back to here real quick. So some of the other key numbers to kind of look for in Fibonacci in general are down here at the very, very light blue box 0.786 and 1.272. And I'm going to show you how to kind of use these numbers, because you're not going to use all of these numbers, but you will see these on your Fibonacci tool that's already built into your MetaTrader 4 or NinjaTrader or Thinkorswim platform, whatever charting platform you decide that you kind of really want to use on a regular basis. Fibonacci is already built into it. The numbers are already there, so you don't have to go in and type these out or anything like that. Really, really, really simple. All right. So if you want to memorize some numbers, these are the ones you want to really memorize. 23.6, 38.2, 50, 61.8, and 78.6. The ones on the right hand side, we're going to work on those later as I kind of teach you guys some other aspects of Fibonacci. But these are Fibonacci extension numbers, and we're just going to really focus on what's called Fibonacci retracements. So the numbers on the left hand side are the ones I definitely want you guys to kind of start to, as you see them, they're not going to be foreign to you after tonight. So 23.6, 38.2, 50. Obviously, if we took that 2 divided by 1 at the very beginning of the Fibonacci sequence, that's how we're going to come up with 50, 61.8, and then 78.6. So those 5 Fibonacci numbers are the only ones to kind of pay attention to right now. If you have 100, it's going to be a double bottom, or that previous point where we started in the market, and I'll kind of show you guys that on the charts here. You guys with me? Just let me know we good so far. I feel like I'm talking fast, so definitely slow me down if I'm going too quickly. All right. So let's kind of talk about Fibonacci retracements, okay? Now, when you're on YouTube, because I know everybody goes to YouTube after they learn something from anybody, that's how the world works. But if you're on YouTube, then you want to make sure that you're learning this correctly. Fibonacci retracements are what are really market pullbacks. So the market will go in a direction and then it will pull back. Okay. So the market on this left-hand side of the chart, the market pulls up, then the market pulls back, and then the market continues to go. So we had the black line going up, market coming back down, and then the market going back up. So what a retracement is essentially is the market is going in one direction, and then it retraces or retracts, it pulls back. In this example, 50% of the move that it went. So it goes from this bottom 100 up to 0, pulls back 50%. So if we look directly across to the left where this thing started, the market came back 50%, and then it continues on. We are looking for these pullbacks in the market, and based on those Fibonacci numbers, that's where we're looking to get into the market and continue on in the direction that it was already going. So if we're going in an uptrend, we're kind of finding that reason to get involved in the uptrend, and we're going to use Fibonacci numbers to help us. Same thing on the right-hand side. If the market is going in a downtrend, we're going down and the market pulls back 50% against us or retraces 50%. We're going to use these Fibonacci numbers to get into the market and then continue on the way down. Okay. Now we're going to kind of look at some charts and demonstrate how this is. All right. So let's pull up. Let's see. What do we want to look at tonight? We're looking at GBP USD. All right, now let's turn off all of the stuff to make the market go. And I'm going to go out to a daily chart. Obviously, the higher the time frame, again, the higher the time frame, the more powerful any of these indicators or these tools are. So I'd like to show you guys stuff on the daily. But this also definitely works on any other time frame, the 4 hour, the 1 hour, the 15 minutes, the 5 minutes, depending on what you're looking to trade. All right, so this is the GBP USD on a daily chart. And what we're going to do is grab our Fibonacci tool. I can't remember if it's on your MetaTrader 4 by default. If not, what you need to do is right click on the toolbar. So you have these tools with your cursor and the crosshairs and all that. You need to just right click on that and go into customize. And then on the left hand side, you're going to see Fibonacci on the left hand side. I've already have it inserted, so let me take it off real quick. All right, so if I go, where did it go? Where did it go? Where did it go? Oops, got rid of the wrong one. Okay, move. All right. So if I look under available and it says Fibonacci retracement, I'm just going to go ahead and click insert. And then also Fibonacci extension, I have it already selected and added, but you'll want to go ahead and add that as well. We'll talk about that later on, but you can also add that. If you kind of want to use some of these other tools, the ellipse, like if you want to draw like some circles or something like that, you can definitely add any of these tools over here to the right-hand side that you want. And then you can also readjust these up and down wherever you want them to show or display on your toolbar. So I'm just going to move these up for now so that my Fibonacci's are next to each other. All right, I'm going to hit close. So now at the top, I have two little Fibonacci tools. One is just the lines with the little F beside it, and the other one has like an up, like a little up, down, like a little pen thing beside the F. We're just going to look at the one with the lines and the F by itself, and it just says draw Fibonacci retracements. Okay. All right. Everybody good? Let's see. Sandra, I think it's just she's still hanging on. I think Angelica dropped off there. All right. So the way we draw these Fibonacci's is we're looking for a strong directional move in the market. Whether even the market goes up or the market goes down. And Fibonacci is a tool that definitely tests your patience. You have to be patient when you use it, but it's an awesome tool because it definitely tells you where the market can potentially go and before it gets there, and you can use that as a way to really set up your game plan to get into a trade. So we're going to kind of look at the market high starting back here. Okay, the market high back here down to the market low down here. And this is how you draw your Fibonacci tool. You want to click on the tool and you want to draw it in the direction that the market is going. So we have this nice big move that's going down, and then the market starts to pull up. So we want to take and click first at the very high of this market. So the highest top wick that we can go, and we draw it all the way down to the lowest wick possible. Okay. So start it from the highest high and draw it all the way down to the lowest low. Now, obviously, you're not going to know what all happened in the market. Oops, lost that real quick. Hold on. You're not going to know what's going to happen in the market. We'll do a lot of practice on how you can identify you know, how to kind of adjust your Fibonacci as the market is progressing along. All right, back where it was. All right. And so we see that as the market comes down, the market starts to retrace. That first 23.6 that I told you guys about is a Fibonacci ratio that I rarely use because it doesn't hold as strong as the other ones do. So if you want to disregard the 23.6, by all means, you definitely can. But it is a valid Fibonacci ratio. It's just not a ratio that I like to trade. All right. And so the next ratio is 38.2. So as we see the market come back up, this first yellow line for me is the 38.2 level. Okay. The second yellow line is the 50 retracement level. And this third line is the 61.8 retracement level. Whenever the market gets to 61.8, there's like a 90% chance that I'm looking to trade at that level because that's a very strong level in Fibonacci. The same level that we saw where the 1929 market came down and just stopped and turned around, is the same level that you can use to identify market movements, whether they're in Forex or stocks or cryptocurrencies and Bitcoin and all that. Those are the same levels that I'm looking at on a regular basis. I'm looking at 38.2 levels. I'm looking at 50 levels, but I'm really looking real strong at the 61.8 levels and also the 78.6 levels. And again, these Fibonacci ratios are how you build out those harmonic patterns that are on the scanner. Okay. Now, I don't know if any of these scanners have anything lined up right now, but if you line up a harmonic pattern with a Fibonacci ratio, that's going to be a really solid trade as you're trading and trying to find setups in the market. All right. So we have this market come down. We look for a pullback. So market pulls back 38% of the movement that it went down. Then it pulled back 50% of the movement that it went down. Then it pulled back to 61.8% of the movement that it went down. Now, if it continued up here, it would pull back 78% of its move. So the total overall move that it went down, it could have pulled back 78% of that move. And then if the market pulls all the way back up to where it started, it's 100% retracement. Okay, so pull back 100%, and then that's where we also have our support and resistance level as well. So if it pulls all the way back up here, we can have a horizontal line to identify, previous resistance. So, and it's something we talked about very early on. All right, so let me draw out another Fibonacci for you. And I see Fibonacci so often, like no matter where I pull my chart to, I automatically see it and it automatically jumps out to me. So as you guys are learning different aspects and you see something that jumps out to you, definitely you want to focus in on that. So if you got questions, let me know. All right. So I'm going to take another look at this move. We have a nice movement up in the market, and then we see the market come back down. See the market kind of go up, come back down again, go up, and come back down one more time. Okay. So we identified a nice push up in the market, nice bullish momentum push in the market, and we want to find a good entry point to get into the market. All right. So what we can do is, again, when you use multiple indicators and stuff like that, it definitely helps you get a good idea of where you can get into the market. If we look at this particular indicator I have on here, is the CCI. It's the way in general that you use it is the same way that you use any of the other indicators. In this particular one, anything that's below -100, which is the bottom dotted line, you're looking for a buy signal. That's your buy signal, anything below it. And then anything above the 100 is your sell signal, on a general terms of how to use it. If I kind of remove these extra lines I drew on here, what I can do to find another type of way to get into this market outside of using these overbought and oversold indicators is to use Fibonacci. And so what I'll do is I'll take my Fibonacci from the bottom and I'll go up to the highest high of the move before the market starts to correct itself. Okay. Now, hopefully I can zoom in without this jumping on me. Okay. So I can kind of show you. There we go. So I went up to this first high of the market move. Okay. I clicked down from the lowest low and I dragged up to the top and clicked again to stop it there. So when I see the market pull back this time, it pulls right back into 38.2. And I could already have a predefined order sitting at 38.2. As I see the market start to pull back, I'm going to pay attention to these levels. And so if you had a predetermined order at 38.2, you can see how solid this level was acting as support. And then the market bounced up off of that. So it actually went from 156.70 up to this initial push of 158.52. So that's a nice 80 pip move that the market jumped off of this potential Fibonacci level. And then we can see again, it comes down, the market tests this level again, and then it bounces up again solidly up to the 159.40 area. Okay, so that's a nice, close to 300 pip move just using Fibonacci. Now, if we look down here at the same time, we see that this CCI is down below the -100, which is our buy signal. So we can see at the same time we got this buy signal, we also had a nice Fibonacci level, support level that it was at. Then if we kind of look a little bit later on here, we see that this Fibonacci level is tested again at 38.2, same level, having a buy order in there or waiting till the market gets there. If you're looking at it in real time, you can use this as a way to get into the market. And then again, at the same time, we kind of see that CCI is under 100 again, under -100 before the market starts to push up. Okay. Got questions? Let me know if you're able to type them in. All right. Let's kind of look at, see if I can find a deeper pullback for you this time. All right. Here's one. Again, I pick random charts, so I kind of don't know. I don't do any like pre-homework things to show you perfect examples. It's just how often Fibonacci works. All right, we can see that we have this nice low in the market. Market pulls up. So it's one of these tools that you can use that if you're behind in the market, you're late in the market, you just wait for the pullback. So it's kind of like the Bitcoin craze that's going on right now. You know, Bitcoin's going straight through the roof. We wait for the pullback. You know, you don't want to buy it at market highs. So we see the market has a nice move up, and then we kind of just wait. Okay. When I first started using Fibonacci, I just waited for market corrections to come right back to 61.8. That's just what I did. So I click at the very bottom, I pull it up to the highest high, right? And then I see, let me get rid of this so it doesn't confuse me. Let me zoom in a little bit tighter here, all right? So the first level this market comes back to is the 38.2, and we can see that this candle, this red candle, like stops right on 38.2. If you trade it right off 38.2, that's not a bad trade. You were able to definitely cut your losses early because you see the very next candle broke through it. So you know that your trade is not valid anymore. All right. I'll definitely go into my strategy of where I put my stop losses and all that kind of stuff on Thursday. Just remind me on that. Then we look at the next Fibonacci level. So I don't trade anything in between here. I'm really trading levels. So I look at the 50% level, and we can see when the market gets to the 50% level, it bounces up from this 50% level and it goes right back up to this 38.2 level. The difference right there is from 152, let's do 152.15 to 153. So you're looking at an 85 pip move just from buying off the 50 level and selling back up to the 38.2 level. Right. Now, if we go down to the 61 level, in this particular one, the 61 level didn't hold, it broke through. But if you had your stop loss below the 78.6 level, that's why I'll talk about stop losses on Thursday. If you had your stop loss at the 78.6 level, you would have gone in a slight drawdown, but you would take this thing all the way back up and rode up the trend. I want to talk about stop losses now. I got to wait till Thursday because I got to show you something else before that. How do you stop losses in fibs? Now, again, you can trade at any of these levels based on certain strategies and stuff like that. But I want to show you something that Fibonacci prevents you from getting caught up in as well. If you just took this trade based off this CCI down here, you would get confused as to which way this market is going, because you would have tried to bought it way down here. We see that this thing is well below -100. And if we tried to buy it off of here using just that, we would have tried to buy this thing for a long-term trade because this is a daily chart. And we see that the market would have continued to go down as this CCI is continuing to go up in a trend. And when you're trading with multiple indicators, it allows you to get these better entries without getting caught on the wrong side of these trades for too long. And so if you won this trade or whether you lost this trade, You definitely can wait longer to find the next entry point by using Fibonacci's. Man, there's so much stuff I can teach you guys. You can wait for another entry using these Fibonacci's to get in, and you won't get caught in this continual downtrend as you start to see, this indicator down here keep telling you to buy, but it might not be a good buying opportunity in general. If you took this for short term, it was a nice short term 2 candlestick win. But if you're trying to use this tool, to continue to get into this trade, you wouldn't have had another real entry to get into this trade until here. But again, it's not a good trade if you're just trying to use the CCI by itself. If you had a Fibonacci numbers that you can actually use in conjunction with it as a reason to get into the trade, that's what makes it a better trade to get into. I hope that kind of makes some sense. There's so many different aspects I kind of want to teach on. Time is always the factor. All right. Let me grab another chart real quick. Let's see. Let's do, let's see something. Let's do NZD-USD, so the New Zealand dollar versus the US dollar. All right. And let's kind of switch over to the daily charts here. All right, here's a good one. Let me zoom in. So this is more recent. All right. So we have a nice market. Let's get that to stop jumping. Okay. All right. All right. Market comes down nicely, right? Then it starts to pull up against us, and then it continues to go down. So if we can't find a reason to get into this market, we just kind of wait, right? So if we're looking at the downtrend of this market and we're looking to sell, so our bias is to sell, to go with the trend of the market. We want to get that good entry to get into the market. As the market starts to pull back, we're starting to get our eyes ready for selling opportunities. Okay. Now, if we just use, candlesticks, we might have got caught by this candlestick right here, because this is like a nice little fake out candlestick. Whenever you see that big long wick, we're waiting for the selling to start to happen, because we know there's a lot of sellers in this market. People tried to push this price up, the sellers drove it right back down. But if we tried to sell it right there too early, we would get caught up in this move as the market continually got higher and higher and higher. Okay. So again, using multiple indicators just helps you get better entries, and you're not going to win every trade, but it just helps you get better entries. Now, if I use the CCI down here, same thing happens. We see that we're over 100. If we would have sold, we would have lost. If we would have basically just got in too early. Now, let's take a look and draw Fibonacci in the same zone here. So we draw it from the top, draw it down to our lowest low. So our highest high up here to our lowest low. All right. We see that when this market pulled up and we got this big extended wick on this candle, there's a lot of room. Let me try to zoom in a little bit tighter here. There's a lot of room between where this market actually stopped and where this wick is. I like to trade my Fibonacci's when when Fibonacci is acting as a solid support. This wick is so far away from where this market actually got to that I wouldn't have sold after this wick, because there's just a big gap between here and here. Okay. So let me grab a little square. There's a big gap between where this market closed at. Okay. That's what I'm really mean, between where it closed and this 38.2 level. Okay. As the market continues to get closer and close at that 38.2 level, or any respected level for that reason, then you can start to look to take those trades. So as it got like to this candle here, this nice green candle, and it just stopped there, then you can start to look to potentially take that trade short. Okay. Because it's like right up against that candle. All right. Excuse me. I didn't mean to delete all of that, but since I did, let's go grab another chart real quick. AUD JPY. Let's look at this one. All right. And daily chart, daily time frame. All right. Here's a real-time setup. So this is something we can kind of look for real time. We've had this nice market move up, and that way you guys can kind of see how I kind of use this. Had a nice real move up in the market. Market pulls back down. Market goes back up, and now market's coming back down. Okay. I want to look at my bias here is a buy because overall we have the market going up. If I'm looking from the left side of my screen to the right side of my screen, the overall bias is that this market is going up and it's starting to pull back. So I'm going to look for the lowest low that I can find on my screen. Okay. Now I have a whole bunch of reasons of why I draw my Fibonacci starting at one level versus other levels. I have a 13 candlestick rule, and I'll get into all of that stuff as we can keep on going. But this is kind of like an overview of how to use Fibonacci. And so when I go from the lowest low back here on April 18th, and I'm going to drag it all the way up to the highest high back here, I'm going to start to look and see what this market is doing. Okay. And when we got to the 68 level, we see that the market broke through. So if I was in a trade, if I had just used a pending order, and if I was in a trade right now, I wouldn't be happy if I had bought right at 68.1. But my stop loss, I know where my stop loss will be, and again, I'll get into it later. My stop loss is just below 78.6 because basically what I'm doing is giving myself two levels to get in at. And 68.1 is a very strong level to look at to get into the market, anticipating the up move, the correction move. Now, if it breaks solidly through here, just like support and resistance, when you see candlesticks break a support and resistance level, it's going to the next support and resistance level. That's just how the market works. So the next level that I would be looking at right now is the 78.6 level. Okay. So that would be already predetermined. I want to put in a potential buy order at that level. Now, unless you really don't have time to look at charts on a regular basis, like once a day, then you can use these pending orders. But I like to pay attention to price action as the market gets here as well. So since this is a daily chart and every candle is a day, I want to see a candlestick get down here and just stop right at this level, or I want to see a hammer pattern stop right at this level. And then if you want to wait for a confirmation, the three white soldier candlestick pattern or a bullish reversal pattern right off of these Fibonacci levels, that's another factor that you can use to get into your trade. And so as a real-time alert here, this is kind of how I'm setting up this potential trade. Now, let me zoom out a little bit here. Now I'm going to do one thing that's a little bit different here. Now, if I take my Fibonacci level where I started at and kind of drag it over here to my first lowest low that's back here, you see that it adjusts this a little bit here, like where the actual levels are. And I'm going to zoom back in and you'll see it. You'll see that now we have a clear break of the 68.1 back here and a clear support of 61.8 as the market tried to come back and break through it. This candle literally stopped on 61.8 and sold off 61.8. So there's so many different ways that you can use Fibonacci. And then one of the main ways is definitely using it as support and resistance because they definitely hold up. The psychology of the market just acts that way with support and resistance, and using Fibonacci gives you a reason to kind of get in and look at these specific levels in the market. So seeing that, readjusting my Fibonacci just that slightly, I'm definitely anticipating this to go down to the 78.6 level. Now, some people, if they see that anticipation, they'll sell it down to that level, okay? And they'll have a stop loss above their entry. I'm the opposite way. I tend to like to wait until it gets to the next level. So however you kind of see the market, or when you're doing your practice testing and whatever works for you, that's kind of what you want to go with. The way I do it, that's because I'm not a momentum trader. I'm more of a counter trend type style trader. So I like to wait for this to get down to 78.6 and make my decision there. But again, some people, once they see it break the 61.8, they're looking to sell it after that break, just like they're selling support and resistance like normally, and they'll wait for it to get down here to this 83, what's that, 83.43 area. So from where the market is right now, you could potentially gain 100 pips just by selling it if it goes to that 78.6 level. So Fibonacci's definitely tell you where the markets can potentially go. It gives you a heads up. So again, it's a leading indicator. You can draw these on your chart, and ahead of time, we already can anticipate where we think the market is going to go, instead of waiting on a buy indicator or a sell indicator after the market's kind of gone past that zone. So on Thursday, I'm going to show you guys an entry if you use the Fibonacci. Hopefully we can find something in real time. If you use the entry using a Fibonacci level versus using a indicator like the MACD or the RSI, where would one person get into the market versus where would the other person get into the market, and what you kind of want to look for depending on, you know, what's more comfortable to you. I can't remember who it was last week was talking about confirmation. So we'll kind of look at confirmation when it comes to that. And if you're more of an aggressive style mentality type trader, trading right off Fibonacci levels is something that you'll probably like. Again, you want to do, you know, some back testing, test it on your practice accounts. If you need help drawing them out, let me know. We'll do some, you know, some training, some videos on it. I haven't gone through the IML's videos for Fibonacci just because I already know it and I've done it so often. So I might need to do that just to make sure that the content kind of lines up with my content that I'm teaching you guys, that I paid way too much money to learn just Fibonacci. So if you have questions, let me know on that. Anything before we jumped off? I know I gave you a lot tonight, and I'm just touching the surface. I always say I'm just touching the basics, but I feel like I am, because there's so many different ways I could go really in depth on it based on like strategies that you guys want to fulfill. You know, overlapping fibs, you know, I got 2 fib zones, creating zones and all kinds of cool stuff like that. So drawing up charts is definitely fun to me. It's like a puzzle, trying to find, you know, where people are looking to get into the markets. And the more you draw stuff up there, the more you kind of start to see things that are kind of giveaways in the market. So I want to draw Bitcoin real quick, but I'll do it on Thursday because I'll show you the same concept on Bitcoin. But the more and more that you draw this stuff up, the more and more you'll start to see it. And Sandra, if you really like Fibonacci, I can teach you Fibonacci for days on it. Any questions? Any questions? I know you're on your phone, so it might be hard to type. All right, definitely reach out to me if you have any questions on it. And again, on Thursday, we'll kind of look at using Fibonacci as entries. We'll talk about entries, but using Fibonacci as a potential entry point, and versus using oscillators and indicators as an entry point, and looking at the harmonic scanner for the entry point. So kind of using the combination of 3. That way you guys don't have to rely on one by itself. You know, you don't have to rely solely on the harmonic scanner for entries, or if that entry zone is too wide, using other things to kind of cut that entry zone in half or in a quarter. That way you don't have to use big stop losses and take too small of a trade where it's not, you know, you're not going to make that much, because if you take too small of a trade, you can't make that much. So all this stuff in conjunction with each other does like wonders in the trading world. So definitely got anything, reach out to me. And then on Thursday, we'll continue on with this concept. So that's all I got for tonight. I guess I will see you Thursday. If you don't have any questions, last call.